everyone. My name is Olga. I'm head of research at International Swaps and Derivatives Association. Today, I'm going to talk about the role of derivatives in sustainable finance and provide an overview of products and transactions that comprise the universe of environmental, social, and governance ESG-related derivatives. The transition to sustainable economy will take a massive amount of long-term funding. The financial sector will be an essential partner in this transition by facilitating required financing, helping market participants manage risk related to ESG investments, and contributing to financial innovation. Derivatives markets can play a significant role in this process. Derivatives products enable more capital to be channeled towards sustainable investments. Derivatives help market participants hedge risks related to ESG factors. They facilitate transparency, price discovery, and market efficiency. In my presentation, I would like to give you an overview of sustainability-linked derivatives, ESG-related credit default swap indices, exchange-traded derivatives on listed ESG-related equity indices, emissions trading derivatives, renewable energy and renewable fuels derivatives, and catastrophe and weather derivatives. I'll start with the sustainability-linked derivatives. Over the past several years, some companies executed sustainability-linked derivatives which add an ESG pricing component to conventional hedging instruments, such as interest rate swaps, cross-currency swaps, or forwards. These transactions are highly diverse and use various key performance indicators, KPIs, to determine sustainability goals. For example, meeting a KPI can result in an increase or decrease in payments, payment of a rebate or a fee, or payment to an agreed charity. The same or different KPIs can apply to one or both parties to derivatives transaction. KPIs can be adapted to specific requirements of the counterparties and the sectors in which they operate. To date, the KPIs commonly seen in the sustainability-linked derivatives can be classified into the following categories. The first one is reducing behavior that negatively impacts the environment. This includes KPIs that are linked to decreasing greenhouse gas emissions, lowering the quantity of waste sent to landfills, or reducing other forms of pollution. The second category is encouraging behavior that is beneficial for the environment. This includes KPIs that are linked to improving energy efficiency, boosting renewable energy use, increasing recycling, or contributing to biodiversity. Next category of KPIs is linking counterparty performance to requirements under international agreements such as the Paris Agreement or the UN Sustainable Development Goals. The final category of KPIs is tracking a counterparty's general ESG performance by reference to a rating issued by a specific third party or a rating system. You can find specific examples of sustainability-linked transactions issued over the last several years in the ISDA research paper, Overview of ESG-related derivatives products and transactions. ISDA has also recently published the white paper that sets out principles for drafting KPIs for sustainability-linked transactions. Moving to the ESG-related credit derivatives. Market participants can use credit default swaps to manage the credit risk of a counterparty where financial results may suffer because of climate change or where a company's viability may be threatened. ESG screening can also be applied to the reference entities of credit default swap contracts. A growing body of research suggests that companies that perform well against ESG metrics are increasingly recognized as offering higher returns and representing lower risk than firms without these goals. In May 2020, IHS Markit launched the iTraxx MSCI ESG Screened Europe Index, which is a broad European corporate CDS index derived using ESG criteria. The index includes a basket of CDS contracts on companies that meet various ESG risk criteria. This index can be used as a macro instrument to gain exposure or to hedge broad ESG European corporate risk. Next, I would like to talk about ESG-related exchange-traded derivatives. With more capital flowing into ESG strategies, global exchanges have recently launched a series of new equity index futures and options contracts tied to ESG benchmarks. While liquidity in most of these new contracts is still relatively low, demand has been gradually increasing, especially from buy-side market participants. ESG futures and options enable institutional managers to better hedge their ESG investments, more efficiently implement their ESG investment strategies, and better manage cash inflows and outflows of their ESG funds. Using ESG futures and options allows funds to meet target allocations in a more cash-efficient way than investing directly in the underlying stocks. ESG index derivatives reference ESG indices, which are based on parent benchmarks that define the universe of companies from which constituents of an ESG index are selected. ESG indices can be based on an exclusion methodology that allows investors to eliminate certain types of exposures while retaining similar risk-return characteristics to the parent benchmark. Some examples of exclusions are companies considered to be non-compliant with certain ESG standards, or companies involved in controversial weapons, tobacco, or fossil fuels. Alternatively, ESG indices can be constructed to gain exposure to high ESG ratings, a specific ESG theme, or generate a positive environmental or social impact. Some ESG indices may combine elements of both of these approaches. Next, I'm going to cover emissions trading derivatives. In carbon markets, market participants can trade emissions allowances, including offset credits, and derivatives based on emissions allowances and offsets. Emission allowances can be purchased through centrally organized auctions or from other companies that have more than what they need for compliance. Secondary trading can be executed on exchanges or in over-the-counter markets as spot, forwards, futures, or options contracts. Several derivatives exchanges offer standardized futures and options derivative contracts on emission allowances and offsets. While trading on exchanges provides more liquidity, over-the-counter transactions provide greater flexibility as contracts can be more customized to meet companies' specific risk management needs. Market participants use ISDA templates for emission allowances, for example, the ISDA US Emissions Annex and the ISDA EU Emissions Annex, to trade swaps, options, and forwards. Derivatives in carbon markets allow market participants to hedge their exposure to potential changes in the cost of these underlying assets and discover prices over longer time horizons. Companies subject to carbon compliance programs use carbon derivatives to meet obligations and manage their risk in the most cost-effective way. If emitters have concerns about the volatility in the cost of allowances, they can either bank allowances or use derivatives to hedge emission costs linked to production several years out. As an effective tool to manage exposure and hedge risk, derivatives encourage investment activity in emission reduction projects. Firms can use derivative hedging to obtain external capital for sustainable investments and net zero activities. Financial institutions can use derivatives to hedge their exposure to borrowers and thus increase supply of credit to the companies that focus on sustainable investments and net zero emission activities. Next, we are going to cover renewable energy and renewable fuel derivatives. Renewable energy and renewable fuel derivatives support the transition to a sustainable economy by enabling market participants to hedge against the risk associated with the fluctuations in renewable energy production and encouraging more capital to be directed to sustainable projects. Various derivatives instruments have been created to trade renewable energy and renewable fuels, including power purchase agreements, renewable energy certificates futures, wind index futures, renewable identification numbers futures, and low carbon fuel standard futures. Last but not least, I would like to talk about catastrophe and weather derivatives. Catastrophe derivatives are financial instruments through which natural disaster risk can be transferred between counterparties. Catastrophe swaps are customizable over-the-counter derivatives that enable a bearer of risk to obtain protection from massive potential losses resulting from a major natural disaster, such as a hurricane or earthquake, by transferring some of its catastrophe exposure to investors in return for premium payment. Weather derivatives are financial products that derive their values from weather-related variables, such as temperature, precipitation, or wind. Weather derivatives are typically used by market participants to hedge or mitigate the risks associated with adverse or unexpected weather conditions. The main players in these derivatives markets, apart from farmers, are utilities, insurance companies, and some banks. You can find more information on these products and other ESG-related derivatives issues in the ISDA's research and white papers. In conclusion, I would like to reiterate that we expect derivatives markets to play an essential role in the transition to a sustainable economy. Derivatives enable more capital to be channeled towards sustainable investments. They help market participants to hedge ESG risk and facilitate transparency, price discovery, and market efficiency. Thank you for your attention.